we will be learning the basic concepts of income from house property, its computation method, and different deductions involved under this chapter. When we talk about income from house property, we have to compute the rental income of a landlord by way of letting out of house property. Such property is let out by a person called landlord to another person called as a tenant. Tenant will in turn pay a rental amount to the landlord at the end of the specified tenure. So one should bear in mind that here basically we have to compute the rental income and tax liability of a landlord while letting out his residential house property during the relevant previous year. Certain questions are always striking the mind. Where any person is engaged in the business of letting out the property, whether such income will be covered under house property, or where any person is occasionally involved in letting out house property, whether such income will be covered under house property, or where any person has let out his vacant plot or any adjacent area relating to the property, whether such income will also be covered under house property? Yes. Here the answer will be yes. Either landlord is involved occasionally, permanently, letting out of any house property, any vacant land, plot, or any other adjacent area of the property, such all rental income will be computed as an income under the head income from house property only. First, we have to identify the gross annual value, means an expected amount of rental income. Such gross annual value is computed by comparing four information like municipal value, fair rent, standard rent, and actual rent. Municipal value is the value as decided by the local municipal authority. Fair rent is the value at which property is available to everyone commonly at any specific area. Standard rent is the rent fixed by the Rent Control Act. That means minimum to minimum such amount may be receivable by the landlord. Actual rent is the rent actually agreed to be receivable in the accounts by the landlord. Now, gross annual value is evaluated by comparing municipal value or fair rent, whichever is higher. But this amount shall not exceed the amount of standard rent. Further, such resultant figure is compared with the actual rent, and higher of the resultant amount and actual amount, whichever is higher, shall be the gross annual value. One point should be noted here. We have learned about the concept of bad debts under accountancy. As you know that under business transactions, we usually sell our products on credit, and there are chances that the party may not pay the due amount due to certain extraordinary situations under business. At that time, we record such loss as a bad debts in our books of accounts. Similarly, while computing income under the head house property, there may be some tenant who does not pay the due amount within the stipulated time of property let out. Within the same year, we record such amount as an unrealized amount as a loss and deducted from the actual amount receivable. Such unrealized rent or loss could be allowed as a deduction only if certain conditions are satisfied, like such tenancy should be bona fide or genuine. Such tenant is not in the occupation of any other house property like property B. Such tenant has been served with a legal notice, and all reasonable steps have been taken to compel the tenant to vacate the property. Now, it is worthwhile to discuss about other deductions available from net annual value. Next deduction is municipal tax. Municipal tax is allowed as a deduction from gross annual value. Such amount is payable to the municipal authority and allowed as a deduction if actually paid during the year. Suppose municipal tax payable during the year is rupees 50,000, but actually paid by the landlord is rupees 25,000. Here, in this situation, only rupees 25,000 shall be allowed as a deduction and balance rupees 25,000 shall be outstanding and will be deductible in the year in which it is actually paid to the authority. One point should also be noted here that whatever amount we have paid in the current year relating to the last or previous year, that amount shall also be allowed as a deduction in the current year itself. Now, after deducting municipal tax, the resultant figure is net annual value. Out of net annual value, further two deductions are available under section 24. First is standard deduction at the rate of 30% on net annual value. This deduction is available to every landlord, every taxpayer, irrespective of any income clause. Second deduction from net annual value is interest on loan for construction or acquisition of any residential house property. Such interest on loan has been categorized into three parts from the tax perspective. Part A, for let out property. Here, 100% interest is allowed as a deduction, where loan has been taken for the purpose of construction or acquisition of the house property. Here, actual amount of interest paid or payable is allowed as a deduction. Second is self-occupied property. Where loan has been taken on self-occupied property, here interest shall be limited. Here interest will be allowed as a deduction only up to rupees 2 lakh. And any amount beyond rupees 2 lakh shall be ignored and will not be allowed as a deduction. Point number third, for pre-construction property. Where any loan has been taken on a property where construction is required. On such property, interest on loan is deductible only after the date when property is ready or construction is completed. Such interest before the construction will be added and will be allowed as a deduction in 5 equal installments from the year in which property is ready or construction is completed. Let's have a quick recall and the benefits while availing loan for the purpose of purchase or construction of house property. So today we have covered the basic concepts, different expenditures and deductions available under house property and computation procedures. In the next video lecture, we will cover about different aspects of income. Keep growing, keep learning. See you next time.